investment advisor before placing any trades. All securities and orders discussed, tracked, and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither philstockworld.com, PSW, nor its affiliates, nor any of the respective offices. Personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involve risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on a specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
All right, cool. So, it'll be interesting to see how the market reacts to this. I have, let me see. I have 2 short on the Russell, and I have 2 short on the S&P, and they're both right where they are right now, in fact. So we will see how those play out. I'm pretty confident that we should get a nice pullback, though. We posted up lines earlier today. Let's take a little bigger picture. The dollar's gotten is up there. It's staying up around the 94 area. But not super strong, but at least not still getting weaker. All these guys, they hit basically the Dow hit the top here of the resistance. These guys are their first resistance point, but these are silly. This whole move is silly, and it doesn't take much to knock it back down. And I think the news of Trump losing control of the business leaders, if you lose the support and the faith of the business people in the country, I don't see how you're going to effectively govern. You know, I mean, people know who has the power around here, and he gets pissed off like all the most important CEOs in the country. I mean, unbelievable. So we'll see what happens. So kudos to Elon Musk for being the first guy to quit. He just walked right out of that place. Anyhow, so that's a disaster that we've been looking at. Meanwhile, though, the market generally, if we'll look at the FinVizy stuff, feature here. Meanwhile, though, I mean, this market is crazy. The S&P had a hell of a correction here, but basically it's completely recovered. And, of course, we're all gung-ho to short over here. That is 24.80. You know, but for me, 24.70 is good enough, so I started shorting 24.70. I don't mind adding to it if we go up higher. Mostly, I decided to, like, you know, the Russell failing 1,400 to me was a sign that this was just the bounce we expected. What did I say this morning? I forgot what the numbers were. We laid all this out today. Hang on a minute. Oh, Phil. Articles written by Phil. Oh, Forbes wants me to write for them again. I'm like, are you kidding me? Oh, but it's so funny because like last time I wrote for them, I lasted 10 days. They had a board meeting. The company called a board meeting to discuss what to do about my posts. This is, many years ago. And they ended up redacting my articles from Forbes. They actually wiped my existence off their site because they had so many readers calling and complaining, like, what is this communist ranting going on your, on your site all of a sudden? And lo and behold, though, now they want I don't know what they want me to do. I honestly don't. I still can't imagine they want my actual stuff. We will see how that plays out. That'll be interesting. What was I looking for? Oh, yeah, I was looking for what I said. That's right. I want to find out what I said. That's just in my day. Because whenever I go down to New York, I end up talking to all these, the media people down at the NASDAQ, and I end up having these conversations. And I say to the Forbes lady, I'm like, do you know who I am, really? I mean, or you just know that I'm do you know I'm currently famous? Is that, so I'm like, do you know in the history of Forbes, like, where I should? So, I didn't read the mics. I heard that, or wherever you are, I heard that. All right, hang on. Full control.
You are now muted.
All right. Back to that. All right, so what were we looking for bounces? Let's see how good our predictions are. I think this chart updated. So, we see this is the thing. 22,050. Oh, I see. What we're looking for is the retraces of this morning. This is what I'm going to down. From 12,000. What's the DAX? Stop it. All right, the Dow from 2250, which is right here. Okay, we're looking for an 80-point retrace to 2170. Why? 850 to 2250 is 400 points. So you get a 20% of the run retrace. So that would be 80 points. So 2050 minus 80 is 21,970. So 21,970 right there. That is where we're expecting the Dow to pull back. All right, so we'll see how it goes. S&P. From the 2470 line. So I wasn't here, so I don't want to say how patient I was, so I wasn't here. But now that I got back, as soon as we crossed below 2470, I want to start shorting it again. So it's starting to fail, so I took a chance and took a little short above the line. But from 2470, same logic, okay? This is a 40 to 70 run is 30 points. 6-point retracement. Subtract 6 points from that, and for some reason I did the math wrong. Oh, I mean, come on, it was like 4 in the morning or 5 in the morning, whatever. I mean, give me a break. That's pathetic. So anyway, so it's 2464, and then that would be 58. So we're going to be looking for right here. We're going to come back down to this line is what we're expecting on the S&P. On the NASDAQ, and so I took 2, and so I get $100 per point. So if I get a 5-point drop, I'm going to make $500. And so I even know what I'm going to make when I do it. NQ 5940. Oh, get out of here! What a call! I mean, come on! I called that when it was here. I called 5940. So even those 154. Okay, so here we're looking for a 25-point drop back from 5940. But I said round it up to 5950, which we spiked up to and failed. So we exactly spiked up to where I said the air reject, right? It's a harsh reject. We got rejected at 5940. It didn't even make 5950, but we still want to use that line. In this case, we actually hit the line. I missed it. Otherwise, I would have shorted that as soon as I saw it. And now we're looking for a 25-point drop back to 5,900. Whoa, that's way down here. No, I'm sorry. No, to 25. We're looking for a 25-point drop to 25, and then maybe a 50-point drop to 29. The Russell, I said, was the most interesting because, in theory, the Russell is going to tell us where the break is. So from 1370, again, that's where I just put my shorts on the Russell, we're looking for a drop, and I worked it out. So in the bigger picture, 1430, 1370, 60-point drop. So 1372 and 1384 are where we said there'd be a point of contention. And what I said here is your range is 32 to 84, and we're either going to break up or down from there. So what happened this morning after I left, we broke up over it, then we come down and we hold 84. Because I wrote that when it was way back here. So there's a 5-minute chart. Let's look at it. Well, so the point being that we were looking to go between 1384 and 1388, and whichever way we break is where the market will break. So first we broke over it. Now we're breaking back under it in theory. So let's remember that 1384 to 1388. We'll look at the bigger 5-minute chart. Russell. I don't know if the hourly thing tells me. No, you got to look at the bigger 5-minute chart. So when I wrote that, it was like here. And see where it is? 1384 gets hit, and then back to 1388. And whichever way we break out of the range, we broke out of the range bullish here, and that's when the market took off. And see how fast it took off once we broke over the line? So that's what I mean by the range. You can see how the range is defined from 1384 to 88. And that's just, and I calculated that back here, and it's just the 5% rule telling you what's going on. Because if you look at the bigger picture, that's a 5-minute chart. If you look at the bigger picture, what happened? 1370 to 1400 is a 30-point run. So your retraces are going to be 6 points to 94, and then you're going to have another 6 points. It's going to take you down to 89-ish. And we went below that and come back. But then we know the range here is 1400 to 1380 is now a 20-point range. That gives you 84 is your weak bounce, and 88 is a strong bounce. And if you get over the strong bounce, it's a strong chart. If you fail the strong bounce, it's a weak chart. And at the moment, we're coming back, so we kind of went over briefly, but only a spike, and now we're coming back to test 84 from above. And again, I have two contracts, so I normally make $100 a point on that one. Let's see. Any thoughts on RB being 10 cents lower for October than September? Also, with the big Jordan CEO today, why is the price lower after the report? Oh, let's look at the bigger report, yeah. All right. The random fluctuations between the contracts is not much to read into. There's really 10 cents lower October, September is what? Is 3% of the contract? I mean, that could change tomorrow. I don't think that's a really big deal. As to the drawer today, though, let's take a look at what we're looking at. First of all, this is a big mistake. I was just talking to the Reuters guy about this. People get very confused that oil is demand, but oil is not demand. Oil is oil is the base material. Okay, it's the thing you are working with. What you're creating, the things that is demanded, is not oil. The thing that is demanded is gasoline and diesel and distillates, right? So it doesn't mean anything if there's a draw on oil. It just means the refinery opened their doors and scooped up a whole bunch of barrels of oil and started processing it. But that doesn't mean there's more demand. That just means the refinery decided to process more oil. We noted last week that the refineries had increased their production, but most of it was to export. My voice is going. Getting cough. Petroleum. So hang on. And see, the report they file at 10:30 is useless, but at 1 p.m. we get all the numbers. So 1 p.m. report. You always want to make sure you're looking at today's date. So from August 11th, and today is the 16th, I guess. And let me embiggen that for you. Control plus. Okay, there we go. So you're looking at 8.9 million drawer in oil inventories. Okay, but crude oil inventories blah 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 blah. Gasoline decreased, and distillates increased by 700,000. So, or actually, total gasoline remained unchanged. That's a weird thing. So there was no draw on gasoline. Nobody used more gasoline, and nobody used more distillates. And propane is 1.6, and we were getting ready for the winter and making more oil, making more distillates or other oils, whatever you call it. But the bottom line is the refineries are running. Look at the input. Look at the inputs to refineries. Last year it was 16.7. Now it's 17.4. So they're doing 7 times 7 is what, 5 million barrels a week. More oil is going into the refineries. But at the same time, look at the exports. We're exporting 6 times the same thing. Roughly about the same 5 million barrels are being exported. So basically, all we're doing is exporting more oil, or more finished products, not oil. We're exporting finished petroleum products. We're importing the same. What's this total? Oh, net imports. Notice, so the net imports were 6 million last year. Now they're 4.9 million. So we're importing 1 million less barrels a day net. And that's what, 7 million, and it's really more than that. It's really almost 1.2 million. So you're talking about 8 million barrels a week oil that we are net or less net imports than we had. So that's where the oil is going. So of course you're going to have a draw on oil, but there's no change in demand. There's basically no change in demand since last year. And if you look at the product supply, did they supply more oil? Did they supply more gasoline? No. It was 976, 9746, 43, 43, 71, 71. No changes. So this is not a demand issue. All it means is that we're using oil and shipping it out of the country as refined product. Our refineries are selling oil overseas. Why? Because they changed the law. They changed the law to allow them to sell more stuff overseas. That's what this is all about. But don't confuse that with demand. It's got nothing to do with demand. We in the U.S. are not demanding anything. In fact, if we weren't demanding so little, they wouldn't be able to sell so much overseas. So the net U.S. demand is way down. And that's why oil prices can't get excited. And if it wasn't for OPEC curtailing the amount of oil that's coming through, this would be a complete disaster for them. Where is that oil chart? Now, don't forget that, as I said, 47 is going to be down. See, that's why we cashed out here, see? That's why I said take the money and run. No point in being greedy. I just said that in chat right before the webinar. Until the 22nd, till next Tuesday, they've got this tremendous contract pressure. Yeah, let's look at that. I got to look up the name of that chart. I'll show you because it's kind of important. What is the name of that chart? Future.tradingcharts.com. Okay. F-U-T or, oh, that's it. Futurestradingcharts.com. Quote. Oil, energy, NYMEX. There we go. So, they still got 205,000 open barrels of oil as of the beginning of today. And 3 business days before the 25th. So we got 1, 2, 3 days before the 25th. 20 seconds left is the expiration date. So they have 1, 2, 3, 4, 5, just checking before doing anything. They have 5 days to get rid of 200 million barrels of oil. So they basically have to get rid of 40 million barrels of oil per day, 40,000 contracts per day, have to be shoved into this month or this month or this month. Well, I mean, they could shove it into a longer month, but they usually don't go more than 2 months because it's expensive. You know, don't forget they have to pay to roll these contracts. So they're paying 15 cents here, 30 cents here, whatever the hell here. So if they're wrong, they're spending a lot of money to be wrong. They generally will just roll a month or so if they can. So 205 plus 467 plus 190, let's call that, plus 322 is 1184, almost 1.2 billion barrels of oil in these 4 months, in just those 4 contract months. That is insane, because in reality, at the end of this contract period, if they deliver 10,000 contracts actually get delivered, that would be a lot. The rest are all just completely fake orders. But to close the order, the only thing they can do is to sell it to somebody. They're constantly looking for a buyer. There's no buyers. Nobody wants this stuff. That's why the contracts are piling up. That's why in December, you already have this incredible pile up of contracts. The closer we get to December, the more pressure it'll be as they try to do their role. And it's going to get more and more awkward for them to try to get rid of these contracts. So basically, for the next 3 months, there's going to be downward pressure, but especially as we get to these contract expiration weeks like we're in now. As long as you see 40,000 contracts a day here, and that's futures.tradingchart.com, market quotes, oil, blah, blah. As long as you see that here, you're going to see pressure every day for lower oil. What we're looking at to break the cycle is a high volume blow-off drop, maybe like $2 we could drop. So that's why I like to try to keep taking calls. Short call. I keep trying to take short positions on oil, but you don't want to be greedy about it because it still bounces. It doesn't stop it from bouncing. But as you see, even that little bounce, that was nothing. Right now, it's coming back to a downward path. So it's going to be very interesting. We'll see what happens. All right. Gold's bouncing a little bit. Silver with a strong bounce. That's a good bounce of silver. Holy crap. That came on fast. What is that line? I'm not talking like that. All right. Sorry. All right. We have good schools here in Golden Wing from the math refresher. Yeah, I need a brain refresher is more like it. So I was up at like 3 today. I'm up at 3 a lot, but I'm up at 3. I work a little. I lay down on the couch. I relax. I have some tea. I have some breakfast, blah, blah. Today I'm like up. I did my post. I ran into New York City. I did a show. I ran back from New York City. Now I'm here. I'm sorry. I'm getting old enough where that starts taxing me when I have to have a day like that. So the older I get, the harder those kind of things are. Let's see. I'm fine if I get a chance to like lay down for like a half hour at some point in the day, but as it's now 10 hours into my morning, that's where I run into trouble. I haven't even not even lunch. I had breakfast. I didn't have lunch. Let's see. Thanks for thought. Almost 6% difference between September and October is noteworthy. No, not really. I mean, look, where are we? Natural gasoline, right? I know it's here. Gas, there it is. RBOB. Okay. All right. So, wow. Well, what was your question? Because look, we're 157 here. That's crazy high. So what were you looking at? I lost track. The original question was 10 cents lower for October and September. Right. Well, okay, so the issue is probably that these guys No, actually, no. I'm sorry. I'm wrong about that. I don't know why that there's such a high number here. That doesn't really make sense. But I will say that I noticed that gasoline dropped, but the pump prices are persistently high. In fact, I was talking about it to somebody this weekend, and I think there seems to be something wrong there because the retail prices at the pump are not reflecting the drop in gasoline we're getting. So this has been going on all month. And that's not insignificant. We're talking about a 10-cent drop here in gas prices, yet for some reason it's not being reflected. It's being reflected in the futures, but it's not being reflected at the pump. And at the pump means this price, basically. So somebody somehow is keeping this price up in order to gouge all the summer drivers. I don't know how they do it, and I don't know what the purpose is. But when they roll over, these things are going to collapse pretty fast. So if I mean, the bottom line here is I'm not sure when this contract date expires, but you might want to hold off on filling up your tank for until that rolls over, because you will save 8 cents a gallon. But other than that, I'm sorry, it was a bigger fluctuation than usual. Usually you have minor fluctuations, but you see here with 146, 163. That's just there's an anticipation of an uptick in demand in the spring. Whether it comes to pass or not doesn't mean anything. They get pretty random as you go further out in contract time. But this is it's something's not right here. This should have gone down, and it isn't. So I'm not sure what they're doing. Long NG December. December 18? It's really far out. I mean, conceptually, I like it. Where are we? Natural gas. I'll go to a weekly chart to look at that. So you want to give it all of this year and into next year. So you want to be out here and you want to be long on natural gas. So, I mean, I'm comfortable with it from this price. I can't imagine we're going to stay this low. We are exporting more and more natural gas. Every time a new natural gas terminal comes on, we export more natural gas. But what's depressing prices, and what's been wrong with our theory that gas is going to go up in the fall, so far, it's not fall yet. But what's hurting it is the Qatar thing. The Saudis have been blockading Qatar and really hammering them. And Qatar, one of their major exports is natural gas, so they are flooding the markets with natural gas at low prices, and that's depressing the price all over the world. And as LNG becomes a more global thing, stuff like that matters more than it used to. Natural gas used to be unique because it was a very local thing. It only mattered because you couldn't transport it. Now that you can transport it, it matters what's going on in Qatar for the natural gas market. So that's a factor. Also, Trump's whole, coal thing is bad for natural gas because natural gas is technically a substitute for coal. But if Trump is going to push coal above natural gas, then the pollution factor that leads people to choose natural gas whenever it's close is going to go away, and that could drive the price of coal lower, the price of natural gas. Price of coal a little bit higher, and the price of natural gas a little bit lower, which is what Trump is trying to accomplish. I don't know, other than the Koch brothers, I don't know what coal people are so far disaster they have to, destroy the entire planet to make that goal, but that's what's going on. Otherwise, though, all things being equal, this should creep up because still we are exporting more and more natural gas. The entire rest of the planet does not want coal. It's just us. Even China does not want coal. They're trying to get off coal. We are the only psychotic the only psychotic country on the planet that is still pursuing any kind of coal policy at all. It won't last. Okay, one way or another, it won't last. Countries are going to start boycotting us if we don't clean up clean up on the carbon emissions. We are a major carbon criminal, and we are not going to be allowed to just pollute while every other country tightens their belts on this issue. It's not going to happen. So, do I like long-term hold? Yes. But you've got to be aware that there's no reason at all it can't go to 250. And that is expensive. That's a 5,000, 5,000. Hang on. Is that right? Is that going to be? Yeah, it's going to be. Is it 4,000 or 40,000? I'm confused. $100 per penny, and we're talking about 40 pennies. No, it's a 4,000. So basically, you're looking at a $4,000 per contract loss at 250. And if it goes to 250 and it fails out, you can go down another 5 very easily, and then you're into it. So the thing is, when you buy a December contract, are you going to just jump at it? Are you going to stop out of it like a normal contract? Do you think you're going to ride it out? And if you think you're going to ride it out, how much money do you really have? So, generally, and I see no reason not to do this other than, it's possible you miss something like this sometimes. But generally, I have just, whenever gas goes down in the channel, I buy it. Whenever it's up in the channel, I sell it. When it's down in the channel, I buy it. When it's up in the channel, I sell it. When it's down, I buy it. When it's up, I sell it. That's been my last action on gas, was selling it here. I've been waiting to see how low the channel goes. I kind of regret not jumping in here, but I still think we're probably going to test 250 again at some point. So I'm just, to me, it's easier to make money waiting. And yeah, there's nothing wrong with what you're doing, but the question is how much. I don't have to ride out the dips. I'm cash, and I wait and then get back in. And if it fails the 250 line, obviously I get out, and then I get back in again when it goes above the 250 line. Or if it comes down to 2, I'd be buying with both hands. That's really how any commodity goes up. You can't impose this. To pretend you have a value proposition on a commodity is very tricky. Even something normal like copper or gold or something like that, you would think there'd be a real value that you could point to. But other than extremes, it's very hard to say what the value of a commodity is at any given moment. It's just so sentiment driven. It's hard to say that even these things matter. Like, the Asian economies have been picking up, and China's putting more stimulus in, so boom, copper goes flying up. Gold is up and down depending on whatever Trump says in his last tweet. So we're doing the same thing. And also inflation hedges, all that other stuff. But gold is actually probably consolidating for a breakout at it's a weekly. Gold's probably consolidating to break 13, but that doesn't mean it's not going to go back to 12 first or 1250 at least. It's just like a stock. I mean, the sentiment drives it in the short term. In the long term, you can go back to a value model. Like for us, the value model here, it wasn't here actually, it was further back. Here at 1050, I was pounding the table on gold because at the time, that's not true anymore. At the time, 1050 was roughly the extraction cost of gold. And I'm like, I'm sorry, you can't keep gold below the price it costs to pull it out of the ground. Not for any extended period of time. It's just unrealistic because nobody's going to just keep losing money. Miners are a little different. Frankly, oil companies do keep losing money, but they have a little bit of a different business model than a miner. A miner is only making money on the mine. They don't have like 10 other things going on the side. They're there to mine gold and sell gold. And if the price of gold is lower than the cost of them, pulling it out of the ground, they'd rather leave it in the ground. It doesn't cost them anything to leave it in the ground. It costs money to pull it out of the ground. So obviously they're going to stop. And miners don't have unions, they're not career guys, blah, blah, blah. A million reasons why mining is different than gold, than oil. Anyhow, so here's where we were crazy for buying gold. Here's where we said, that's plenty of money, we got the hell out. Here we got back in again. And here we're kind of like, it's like, we have longs in gold, but we're not gung-ho for bullish here. But I do think we are consolidating for an eventual breakout back to 1,500. But that doesn't mean we're not going to go to 12 first. I don't think we'll go lower. Although, the weird thing about it is, as I was saying, now ABX, for example, is extracting gold at around 850. They have driven the cost of extraction down. Now, partly they've done that because they sold off all their mines, all their expensive mines were sold off. So they kept all their below average cost mines and sold off all their above average cost mines, which was smart because it helps them navigate a choppy market much better. They're not getting credit for it, but that's the way it's set up. But I'd say their average competitor, everybody slashed costs nicely on mining, and I'd say somewhere between 950 and 1050 is now the bottom for gold. It's actually a good $100 lower than it was when we called this a bottom. So that's why even the 1200 line, even though it's been pretty solid support, because of the low cost of mining, it's hard to say why it would stop there. And that's what I mean. That fundamentally, yeah, I'll call a bottom here and I'll stick with it and I'll pound the table and I'll double and triple down when it comes down here. But here, I don't know. I mean, I don't have the same premise. That's all. My premise here is simple. This is how much it costs to extract gold. Now, this is how much it costs to extract gold. So this is a big difference. And you got to be careful about those kind of things. You always have to keep on top of that stuff. Like our coffee premise. Look at our coffee. They took a shit today. Our premise on coffee is that there's going to be damage to the crops due to global warming, but that's a 2-year, 5-year bet. Who knows when it's going to actually happen? But anytime it's down to 120, I'm a happy buyer. You know, again, we were banging. This is when we started getting interested in coffee, when it came down here to about the 120 line back in late 2015. That's when I picked up on this trade. It went flying up to here. That makes a fortune on the futures. And now it came back down. So back to here. We went long here, we got out here, and now we're waiting for it to come back down again. That's all. But as I was saying, though, I wouldn't go, like, to me, to hold it for 2 years, waiting for something to happen, riding it out through thick and thin. I'd rather get in and out 25 times between now and then and make a bunch of money than wait for that one big score. And although you might miss this, stuff like this happens and you miss it, because if you're in and out constantly, you might be in here and then you get out here and then you don't want to get in there because it just went up. You don't want to get in here and it just went up. You don't want to get in here and it just went up, and now you miss the whole round. So that's the disadvantage of not taking the very long positions. That's why with a lot of things like the oil or silver or whatever, we have our super long positions, like not oil, but on silver wheaton, for example, we have very 2019 positions. Those are nice longs. Short term, whenever there's a dip, I'll play the futures. But my long-term position is always going to make the money. Can you re-explain the math as part of the STP review for TVA and overall hedge goal? Oh, no, that's going to be so complicated. Oh, really? All right. I just said I don't feel like doing math. You're killing me. Just got back on a cruise ship. And the day I got back, I started getting a cough. I'm like, son of a bitch. Some tropical, horrible disease. Oh, you're welcome, Joe. All right. So where are we? That wasn't really just about ABX. I'm just trying to explain to people, like, the concept of these long-term trades, because you lose sight. Everybody's very short-term focused. And you forget that, like, look, we've been doing this for years. It's like the cost is gone. It's like you look at these trades and go, oh, this thing's down. It's like, no, it's not down. We sold thousands and thousands of dollars worth of calls against it over time. So it's no longer important. This is especially on a butterfly portfolio. It doesn't matter what the position is. We don't care. It's just a trading vehicle that allows us to sell puts and calls and make money. The cost of the long position doesn't really matter to us. All right, so TZA. All right, so first of all, let's take a look at TZA in the short-term portfolio. What's the short-term you're asking about, right? Yeah. So here's the short-term portfolio. Here's where it is. We didn't do the changes yet. Here's what I said yesterday. TVA. Oh, why do I have to explain this right there? Come on. I mean, tell me what the question is. I said, look. So here's our position with TVA. We have the 15 calls long. We have the 55 calls short, 2018. We also have what? Oh, that's SQQQ. I'm sorry, but we have the 15 calls long. We don't have a spec. We have the 15 calls long, and we have the $20 put that we sold to make some money. So we sold the $20 puts. We have the 15 calls along 100. That's all. That makes it much easier to explain it. So I guess this question is, we have 100 TZAs at 15. So I'm trying to imagine what your question is. TZAs at 17. TZAs are 3 times ultra short on the Russell. So if the Russell falls 20%, then TZA will rise 60%, right? That's a scientific fact. Although it won't exactly rise 60%, it isn't a fact that, but it's close enough. So 17 times 1.6, 60%. 2720. So so 2720 is where we'll be if the Russell drops 20%. And again, roughly there's decay and all sorts of other factors in it, depends how exactly we are when we get there. But in general, that's what we're prepared for, and that's what we want. We want to know that if a 9/11 happens tomorrow, if a nuclear bomb goes off, like Kim Jong-il blasts, Guam, how does it really affect our lives if Guam is nukes? I don't really get that. I'm like, I know there's people who live there and it'd be bad and all that, but come on, I mean, it's Guam. It's like when we nuked the Bikini Islands for target practice. So what's Guam? It's basically the same thing. It's like one of those little islands that nobody cares about. We have a little military base there. That's about it. But other than that, it's just a thing. So anyway, so I mean, it would not affect our life any more than when we already nuked the Bikini Islands. It wouldn't make any difference. But of course, the reaction we would have would be incredible, and the markets would melt down and be panic everywhere and whatever, which would all be silly and ridiculous. And so would the ensuing action against Kim Jong-un, which would be like a wipeout of him and his regime and everything else. So when the market does dip on, if Korea does nuke Guam, then definitely buy into that dip. That's what I'm saying. I don't need too callous about it, but basically that's got to be your strategy. But that is, you have to step back and look at something like that and think about it. Now, if God forbid they nuke Los Angeles, then you have to say, well, how much damage has that done? What's the insurance damage? What's the loss of income and the wages? How many people were killed? How much money do these people make? How much do these businesses make? What's the disruption to our systems and so on and so forth? To 9/11, there was a cost for the damage to New York, but it wasn't permanent cost. Rita had a cost when the hurricane hit. It had a cost because it shut down things for a few days. 9/11 shut down things for a week, basically. But it didn't permanently damage stuff. A nuke in Los Angeles would permanently damage things. Los Angeles would no longer be a thing you could use. That would be a big problem. That would be then you'd have to look at a serious impact on the GDP. But seriously, if they took Guam out, it would have zero impact on our economic ability. It would do nothing to the United States' GDP. It would be absolutely a non-event as far as the impact to American society. So everything that happened after that would be just psychological crap. So you do have to step back and just be analytical about things like that. So we're hedging for a serious something, and you never know. There could be a huge terrorist attack. There could be a crazy thing like Kim Jong-un, whatever. That's what you want to be covered for. So a 10 to 20% drop that happens without warning. That's the purpose of your hedging. And you want to be able to ride out the damage from that. So in this case, we're saying that I see 150,000 less 30,000 in the past. I'm not sure what that math is. I see 150,000 less 30,000 turned down. Oh no, that was SQQ. Sorry, that's the math for the other guys. With TZA, there I said. Well, then I said with TZA, so 120,000 upside from 17 to. Our calls are $15 calls. So we have the $15 call. So if TZA goes to 27, it's $12 times 10,000 is $120,000. That's where that comes from. So that would be the net $120,000 at 27 minus the $30,000 we already have in value. So we're not going to get, in other words, we get to 120, we don't gain 120, we get to 120, so it's only plus 90. That's what I was talking about there. Then, I have to read myself twice to figure out what I'm talking about. It's actually all correct. It's very complex thoughts being put in very short order. I didn't even skip anything. It's actually very well laid out, but I can see where it can stretch your thinking process because I assume that you're completely following everything I'm saying. All right. So TZA doesn't have March, but the 22 calls are 115. The January 15 calls are 315. So if we had 100 spreads at 2, so how do I explain this? All right, just bear with me. It's easier instead of me showing you a bunch of stuff. I'm just going to say, look, we already have 100 open contracts that can gain that can go to $12 if we hit 27. If the S&P, if the Russell drops 20%, then TZA in theory will go to 27. Then we would have in theory $120,000 from our 100 open calls. We're not changing that. What we are doing is we're adding 100 more spreads at $2, $20,000, and those are going to be $9 spreads. The 15, wait. Yeah, the 15, wait. I don't know why, I should have said 70,000 upside. So 50,000 upside is $70,000 spread. So the 15, 22 spreads are 70,000 less 20. You'd have 50,000 of actual profit upside. I mean, it's $70,000, cash. The reason I say that is because to me, the $20,000 is your insurance payment. It's gone. I don't think of that as like money. I think of that as like I spent $20,000 to insure my portfolio. The long-term portfolio gained like $100,000. We're taking $20,000 and we're ensuring that we keep the $100,000 that we gained. So that's spent money. So I don't care if it goes to zero. I know it seems crazy to lose $20,000, but again, I'm protecting $100,000. So that's my cost of insurance. So it's like with life insurance. If you're paying whatever you pay for life insurance, if you have $1 million policy, you say, "Oh, I get $1 million." You don't say, "Oh, I get $1 million," but it's net of all the things I paid for. It's not, so that's kind of how I think about these things, which I should be careful with. Like, see where you think that's wrong. The upside, if you look at it as a trade, is $50,000 from 20. You're going to make $50,000, but it's more than that because we have 100 uncovered calls, and that means that we can do a 2x roll on the short 22s. So we would roll the 22s to a higher number, and in this case, I think I said we can roll into the 34s. So if we roll into the 34s, this is all projections, though. It's all based on saying, look, you don't know for sure how things are going to go when they move up. But what I do know, what? Oh. August, wait. January. What's going on here? Oh, there are no Marches. That's what I was talking about. Okay. So we have the 15. Okay. We're selling the 22s for $1.20. But we have 200 open, we have 215 longs, we have 100 short 22s. So, without any risk, if these jump up to a higher price, let's say it's a $10 move up in the TZA, right? So if there's a $10 move, the 22s will probably become worth what the 12s are, which is $5. Okay, and ours would be worth, ours would be in the money. 27. Ours would be $12 in the money, so we'd be worth at least 12 anyway. Probably more. So ours would be worth at least $10 more than they're worth now, the 15. So that's more like $13. The 22s would jump up to the price of the 12s, right? Logically, $10 move is going to make the 22s worth what the 12s are now, $5.40. But then we could then split this into 200 of what? Whatever's 250. So let's say the 17. And it's not the 17s, but it means we can move them up $5 more. So when I was looking at this chart, it says we could move them up $5 in strike and double it. So if we sold the 22s, we should be able to roll to the 27s on a $10 move up. That would leave us in the 15-27 spread. All right, but I did the math and I somehow came out with 34. And I probably did, when I did the math, I did a lot of math, believe me. Like I sat there with a calculator. So probably taking all the variables into account, we can go for 34, 35 and on a 2x roll. And that would give us a $19 spread if we have a 15-34 spread in the end. But this is a lot of this is conjecture. Oh, I see. I accounted for paying $10,000 to do it, to make the roll. It wasn't an even roll. It was put some money into the roll. But then we'd have 200 of the 15-34 spreads. Don't forget, this would all be pending the fact that we already went to 27 and we do the roll. So we went to 27, we do the roll to the higher amount. We're now in the 15-34 spread, and that pays $19 a spread, and that's $380,000. So that's how you would adjust it. But again, this is a funny thing, because the last few weeks I've been dealing with people who ask questions that they don't seem to understand how our rolling system works or why we're in these stocks for the long haul or what it is. So I decided to lay out our long-term plans more clearly, like when we're making the site. But a lot of this is conjecture and what if and so on and so forth. Okay, you can't take it as like it has to work. But this is the gist of the plan if things go higher. But then the problem is when I do this, it obviously causes even more questions because everybody's confused about, looking at the 3 moves that we're going to make down the road. If something happens and then this happens and then this happens, then these things happen. But that's what this is all about. So the short answer is don't worry about it. Okay? And you're going to really learn after the fact. The way we're going to learn this stuff is we're going to have these plans, and they're going to succeed or fail. And when they succeed, when things go according to plan and we execute, then you'll hopefully, after a few of those, you'll go, oh, I get it, because then you'll see how these things work out. But none of this makes a lot of sense until it happens. And then when you go back in retrospect, you look at what we planned to do and what we actually did, you'll say, oh, okay, that's how that worked out. All right, but the gist of it is this is a nice, flexible way to give ourselves a lot more upside. We're only spending $20,000 more to get a direct $50,000 more upside, but the nature of it is such that we feel confident that we can squeeze another $100,000 out of it if things start going badly. Oh, it's also conjecture on the fact that we don't think we're going to have a 20% correction all in one shot. Theoretically, the market circuit breakers kick in at 10%. So we don't think it's all going to be like one day you wake up and you're 20% down. So in theory, we will have time to make these rolls and react. And if not, then boom, we're stuck with the money we get at 27. All right, and that's all there is to it. Now, another very, very, very important piece of math that we need to talk about, though, is this. Well, you don't have to mitigate all the damage when you hedge. So, let's say we have $100,000 worth of longs, 100,000 in longs, and we're worried about losing $20,000 on a drop, right? Well, you don't need $20,000 worth of insurance. $10,000 worth of insurance is fine. And the reason it's fine is because if stocks drop 20%, then the things that so you'll have $80,000 worth of stocks, and you'll have $10,000 worth of cash from your short, right? So your hedge will pay you $10,000. Now you have $90,000, but $90,000 is buying at the cost of the stocks that you want to buy with your $90,000 is now 80% of what they were. You follow? So you're getting a 20% discount. So you have less money. You have 10% less money, but the stocks you want to buy are 20% cheaper. So you actually have more buying power now. So if stocks are at $100,000 and you have $100,000 cash and you buy stocks, right? You have spent all your money and you get 100. Let's say it's 100 shares of stock. But if you have $90,000 and you buy $80,000, and you can buy stocks for $80,000, you actually end up with 112 shares of stock. So you're actually, even though you have less money, and again, there's a couple of suppositions here that are hard to get your head around. The base assumption there is that one day the market will come back. Now, this logic has worked pretty much since the beginning of time. One day the market comes back. If you stick to blue chip stocks and successful companies and so on and so forth, they're probably going to work their way out of any kind of recession or crash or whatever. And diversification obviously is key, except for Apple, in which case just buy all Apple. if Apple drops 50 cents, just buy Apple. Don't worry about it. So that's why you don't want to overhedge, because there's no need to have $100,000 when the stocks you want to buy are only $80,000. You're overhedged, right? Because now you're buying 125% of what you bought as far as the number of shares. You don't even need $10,000 according to this. You really can get by on about $6,000. I think $96,000. Let's see, 96 divided by 80. Nope, that's still 120. Wait, it was 90 divided by 80. Sorry, 90 divided by 80, 112. Obviously, 96 more. I'm sorry, so if you had 6,000, it would be 86 divided by 80. That's what I was thinking. 107, still more. So you don't need a big hedge because you'll be able to buy this. Oh, obviously, you'll be able to buy the same amount of shares. So when the stocks come back, you have a lot more money. That's part of our system. Part of our system is we want there to be a market correction because we want to take all the cash we accumulate in the short-term portfolio, and our short-term portfolio has $500,000 in cash sitting in it because we've never had a correction since November of 2013. We've not had a big enough market correction that we've had occasion to take the money from the short-term portfolio and put it into the long-term portfolio so we could buy more stuff. It never happened. We never had a correction that lasted long enough to go shopping. So the point of your hedges is you only need enough money to be able to shore up the positions you have for the long term for the run-up. We would love it if the market dropped 20% or 30%, because then our $500,000 could buy $700,000 or $800,000 worth of stocks. And then when it comes back, that money would zoom up. Then we'd have a lot more money. That's how we make our really big gains. Our really big gains in the short-term portfolio. This is great, but it took 4 years to make 400%, so we're making 50% a year. It's great, but it's not, a bomb. But if we had bought Apple at not 85. What's 85 divided by 7? 10, 11, 12. All right. If we had bought Apple at $12 a share in the crash in 2010, we'd be a damn sight better off than that now. And that's what it's for. That's what this cash is for. It's for going and grabbing those blue chip stocks when they drop like crazy for a temporary reason. So this is our Guam fund, okay? If Kim Jong-un nukes Guam, we spend this money on all kinds of stuff. We start buying all these companies. Unless they're based in Guam, we're going to want to buy these companies because North Korea, yes, it would suck, and yes, everybody would panic, but realistically, North Korea is not going to beat us in a war. All right, it could drag China in, but I don't think so. If North Korea does something like nuking Guam, I'm pretty sure China would be like, hey, dude, you're on your own. I'm sure they would back off. So North Korea is not a threat to us in reality, other than the fact that they could drop a bomb on us. But outside of that, they're not an actual threat. So we would mop the floor with them very quickly. That would be the end of it, and we would move on. The markets would recover. So that's when we want to take this money and put our hedges to work. And that's what I'm saying. You don't want to over-hedge. And frankly, we have been over-hedged. Every time the market dips, we make a fortune in the short-term portfolio, and we have nothing to do with it. We have nowhere to put it. It's just piling up in cash. So technically, that is over-hedged. But, crazy as the market is and crazy as the political situation is, I don't feel comfortable not being a bit over-hedged. But as far as the general portfolio, you really don't want to overdo it. You want to get the right amount of hedging. And right now, though, because of the dip that we just had, because the long-term portfolio lost $100,000 real fast. In fact, as fast as it gained it last month, it lost it this month. Now it's come back mostly. But the short-term portfolio gained it. But the speed at which the long-term portfolio lost money on a very small dip, it made me nervous. That's why I'm bumping up the hedges. That was the logic to doing it. So I did feel that we might be a little under-hedged, and I almost would rather liquidate the long-term portfolio at this point. I'm not comfortable with all these huge positions. We have a lot of money tied up in positions, and they are very volatile. They're very leveraged. So I don't have enough confidence in the market. But on the other hand, not being in the market is crazy. You can't not be in the market. It goes up every day. So you have to be in it. So a lot of cross currents, basically. Oh, the Fed minutes. What did they say? Inflation is below 2% longer than expected. Thank you for reminding me. FOMC meeting minutes, whatever. Schedule statement summaries. Oh no, who are you? These guys. So here it is. The minutes, PDF, HTML. Oh, good God. Hang on, when this happened, 203? We're in the summary right now. Inflation below 2% for a while. Risk to GDP and unemployment are balanced. Anything else? Well, so the market didn't like it. We seem to have dipped, right? Let's get to my short. How are we doing? What is that? Oh, I don't have any wine. That's what. All right, so we got 240 here and 250 there. $500. Not bad. Should we take it off the table, or should we hope it does better? Looks like it bounced pretty hard. I don't like the way that looks. I don't like the way it's so bouncy. I'm going to cash that in. Now we can see 183.57. Oh, now it's going the other way. So cash that out. He's done. Russell is always my favorite short, so we're going to leave the Russell on for a bit and see how it goes. So we got 212 there. I don't know. See 180. I don't like that. See, look at the way the Dow popped real fast. We'll see if the Dow fails here. That'll determine whether I stick in the Russell one or not. That's not bad, right? Those trades were wide when you guys came in, so about $400 in an hour. It's okay. Won't be $400 if I cash these in though. So I'm expecting the Dow to get rejected at this line. So we'll see what happens. So I'm just following it down. I have 2 open contracts. I don't like that. That's too hard. Very few contracts trading here at all. The S&P is where all the action is. Nah, I don't like it. I'm going to take that. I'm going to take one. I'm not sure, so I'm taking one off the table. Now I'll wait and see what happens. The Dow's coming back down. I'll show you. Hang on. All right, so here's the line. Now I'm clean. So this line is 1385. So 1385 breaks. We'll get back in short and use it as a stop. But the Dow, you want to look for what we call a fresh horse. A fresh horse means which index is lagging the others. So if you use these support resistance lines, since the Dow is the only one touching its red line up here, he's the highest. So he's lagging on the fall. All right. Also, the Dow is giving us a clean line to stop out at. This 2230 basically is a clean line to get out of the Dow. So let's take 2 here because the Dow has the easiest profile to short right now. Because if they go over 2230, we get out quickly with a loss. These other guys are in between their resistance points. They're not going to really tell us anything until they get up to here and show us. But the Dow, if it stays under this line, we can be confident being short. All right, now let's see what the Fed actually has to say. I forget how long these things are. All right. The intermediate period, the growth of the uninvestable bonds, advanced economies, U.S. bonds rose, blah, blah, blah. Increase in the Fed's target range was reflected in other money market interest rates. The effective Fed funds rate was near the middle of the new target range over the meeting. Take out the systems overnight. Reverse curve average 200. The reverse repo agreement, $200 billion. Well, let's throw that around. Conditions in the swap market were stable. Demand of central bank brokers were low. The manager reported small asset values. Market expectations for the past of Fed funds with a little change. Survey indicated that most markets anticipated the Fed would announce in the September meeting. Survey results suggested that while views were somewhat dispersed, response expected the effects of the bond yields and spreads on mortgages to change. Okay, so nobody thinks anything the Fed is doing is going to be a big deal or have a big impact. And the Fed likes it that way, frankly. That's what they want. The economic situation. Now, when you're reading these things, you have to realize they're in the past. This is a time capsule that was as of July 26th. So what has happened since July 26th, you have to think about what things are no longer true that would so in other words, the Fed reaches conclusions based on what they knew on July 26th. Since July 26th, we know other stuff happened. So if things are no longer true, you have to say, well, if the Fed would change their mind based on this new information. So GDP expanded faster pace. That's not really happening already. We have a problem because the real GDP, where is that thing? GDP now. I'll show you. The Fed always does this. They always think the GDP is going to be bigger than it is, and they always keep pulling back. They start off with a high number that's insane. Here you go. Wednesday. Okay. So you see, they start off at 4, and they dropped it to 3.5, and now they're at 3.7. So it's lower than they thought at that time. At the time, they thought it was going to be 4%. It's dropped a bit, not much though. Although 3.7 is 3.6 is 10% lower than where they said. Last quarter, GDP now literally went from 4 down to like 2 over time. I don't think this will be that drastic, but I think we're going to settle up around 3. I think these guys will probably meet somewhere in the middle, and it's going to be around 3 in the end. Oh, no, that's not it. All right. Fed. All right, so we know that's a little bit not true, but not terrible. Consumer prices measured slowed again. Okay, that's the way they, as measured, yeah, consumer prices are slowing. Realistically, though, there's a lot of inflation. Which excludes food and energy prices, which of course nobody actually has, right? Land below 2%. Data from consumer and fruit producer prices suggested total blah 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 remains similar. So there's no change in prices that they see. So if you start seeing inflation, they're more likely to tighten. If you don't see inflation, they're less likely to tighten. Non-farm payroll has been solid. You're still getting good numbers. Unemployment is fine. Labor force participation is the same. Average earnings, average earnings increased 2.5%. Now that went down. That's a negative. But that's a negative that makes it more likely to ease or not tighten. Total industrial production rose moderately. I don't know if that's still true. I think industrial production was not so great. Automakers' assembly schedule and motor vehicle production would edge down. That is correct. Likely reflecting somewhat elevated inventory. Broader indicated manufacturing production new orders index are regional, 30 points to moderate gains. Yeah, that's iffy. Real PCE appeared to have rebounded. Yeah, so. However, recent growth, they knew that. And they knew that it was going to have problems. So that's okay. Consumer sentiment remained upbeat. That's still true. Residential investment seems to have declined. And again, we got numbers just this morning that show that there's been a serious decline in multifamily property. So that the Fed would probably consider a negative that would cause them not to tighten. The issuance of building permits for houses is lower. Sales of existing homes decreased on net. That's still true. And new home sales probably versus previous month's decline. That is no longer true. Real private expenditures for business equipment and intellectual property appear to have increased moderately. All right, nominal outlays defense. Real federal government purchases in the second quarter. State and local government spending has declined because they have no money. Payrolls for state. In fact, this will be getting. Well, no, they got the June report. Real purchases by state and local governments appear to have declined. That's because state and local governments generally run their calendar year till the end of June, and they run out of money. They basically everyone's short on their budgets, so they just literally have no money and they stop spending it in June. That will actually reverse and be better, and the Fed should know this. It's so weird. You think they know it, but they don't say they know it. But how could you not know that? Nominal U.S. international trade deficit narrowed in May with an increase of exports and small quantities of imports. Export growth, as you know, we're all gung-ho with the import-export wars. Consumer prices, didn't you just talk about that? Increase 1.5%, blah, 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 blah. Income deficit, economic growth continues to firm growth. All right. So this is very boring minutes, doesn't really say anything. Basically, it says the Fed doesn't perceive any large inflation, so they don't see any particular reason. There's no hurry to tighten. That's basically what this says. So it's not really bearish. Did I leave any open things? I forgot. Oh, yeah, down. So it's not really bearish, but it's not very bullish either. It's just a sort of neutral statement that's in line with where we were. If people were looking for a boost from the Fed, they're not getting it. Now, remember I said we could short these guys below the 385 line, and we're back below the 385 line. Let's see if we stay below it. Nope, so we obviously don't play. And if these guys go over, we're going to get out. So I'm looking for these guys to come under or them to go over. And either we're going to add more here or we're going to give up on these, one of the two. But to me, it's nothing to be bullish about. Yeah, I'm going to go for it. I like having my reference books. These are the same as that 2 we just sold, and now we're just back in the game, that's all. So do I want to be short the Russell Island down? Not really, but usually I have to have one thing and I watch it. But we'll just see how it goes for now. See if we can get it to $1,000 before the end of the webinar. All right. See questions. Okay, so we did that. Little north, please. I don't remember what that was at. All right, Butterfly, Microsoft. I believe one of our 6750 is expiring September 15th review. Yeah, I'm doing a Butterfly review tomorrow, so we'll go over it then. It's not a big deal. Microsoft. Let's take a quick look. Microsoft, September 6750 call, and we're at 73. Well, that doesn't expire tomorrow. What are you talking about? It's August. Pretty sure September one's expiring in September. So our target is that Microsoft sells off a bit. I don't know that they will, frankly. We have the short 7. We have the 60 puts and 6750 calls. We'll probably have to roll them up. We're above our range, so we might want to cash in this whole thing and restructure it. But meanwhile, there's no reason to. Meanwhile, it's a good hedge and it locks in the profit we have on the long position. So at the moment, I'm not going to do anything with it, and I'm not going to change it this week either, because it's not necessary until next month's expiration. Oh, you said September 15th. Yes, yeah, so, being the middle of August, it's not a war yet. What are your thoughts about NVIDIA? I think it seems to me that there's a huge, huge demand by people mining Bitcoins and stuff. That's taking a lot of their chips are going that way. There's the Internet of Things. There's a lot of good stuff about NVIDIA. I certainly wouldn't bet against them, but I don't think they're cheap. Let me see what they make. NVDA. So, is Bitcoin mining here to stay? Is that something? I mean, I believe if I understand the math thing correctly, the number of Bitcoins you can mine is logarithmic progression. So it becomes harder and harder to mine them as they come along. But it's a slow one. So the cost of mining a Bitcoin goes back to the same as silver and gold mining, by the way, something else we can bet on once this market becomes more liquid. If you think about it, a few months ago, Bitcoin was half the price. The cost of mining a Bitcoin was less than $2,000. I have no idea how much it costs to mine a Bitcoin. It depends on what you count as time also, but you have to factor in the computers that you use, the cost of the internet, the cost of the electricity, blah, blah, blah. Who knows what it costs? I'm sure somebody's got the numbers. But let's say it costs $1,000 to mine a Bitcoin, $1,000 worth of effort to mine a Bitcoin. And the Bitcoin comes out now, and it was $2,000 then, so that was lucrative. Now it's $4,000, it's way more lucrative. So that causes more and more people to become Bitcoin miners. But the faster they mine Bitcoin, the harder it will become to mine Bitcoins until it actually becomes impossible. Where it's like doing pi to the infinite thing. At some point you just can't, you'll never get the number. It's just too far out. So what were we looking at? NVIDIA, right? So NVIDIA. So I don't think it's a fad Bitcoin mining stuff, but I think that the frenzy to do it is going to fall into more ordinary usage. Put it that way. So that's been a big boost for them. There was a surprising amount of revenue came out of that. Meanwhile, this is solid, guys. $7 billion in revenue, $1.6 billion in profit. Even if you said $1 billion of that was excess profit, it's not. But let's say $1 billion was excess profit. it still would end up at like $1.1 billion in profit on a normal year, even if it pulled back. And their market cap is $98 billion. So your PE, as it stands now, your PE is 55. That's why I would be long it, because they're really making they're only making 1/50th of what you're paying for the company. So it's taking 50 years to pay you back. So I like the business. It's been growing nicely. It's a good company. I would not bet against them, but I also would see no reason to buy them. Not at this price. That trading failed long, long ago. And I mean, 100 to 164. They're up 60% in a few months. So no, it's too much of a leap of faith for me. In your STP, the buying power is negative. Can you add positions with negative buying power? It's where are we? It's not really negative. This thing treats it like it's a I don't know how to fix that. This treats it like it's a whatchamacallit, like it's an IRA. So it basically, in other words, your margin. Look, the margin requirement is 687, even though we have $500,000 of cash. We should have $1 million of buying power in an ordinary account. But also, we've got in the long-term portfolio, which is this is a paired portfolio. Yeah, very important. The short-term portfolio is not a standalone portfolio at all. It is the hedges for the long-term portfolio. To play the short-term portfolio by itself is madness. As well as it does, it still is not. You're basically hedging things you don't own if you play it by itself. In the long-term portfolio, we have $1.2 million of cash. We have probably $2.5 million buying power, and we're using $480,000 of it. So we have $1.9 million, $1.8 million spare buying power in reality in the long-term portfolio, and combine that with the short-term portfolio, which actually has $1 million in buying power. That means that this is nothing. But unfortunately, the way this thing calculates, it calculates like you have an IRA, and it only gives you exactly the margin that you would have for the cash. So, and obviously, you wouldn't play any of these strategies if you have an IRA with a no margin account. That would be crazy. So no. Well, you can add positions with negative buying power, but probably not. Your broker's not going to like it. So. You can try, but they don't do it. AMD is similar business like NVIDIA. Do you like the transfer? I like AMD better because they're more of a value play. But also they've gone. They went from 2. If you look, in this year. They're up a bit. Well, 10 to 1250 is not nothing. It's 25%. But this is the real story. They were at 2. This is when I did like them. We actually were picking them back here when they were 2. Because my logic with AMD is Intel can't let them die. So then Intel's a monopoly. If Intel lets AMD die, Intel's effectively a monopoly. So, when they get down to 2, Intel backs off and takes the pressure off them and lets them get some customers or whatever. But AMD is just taken off, and it's something I'm not into chasing it. I don't have a compelling reason to buy it. I know there's a whole internet thing. Frankly, Samsung is the company to buy, or was the company to buy when they were having trouble. Because good God, they were so low earlier this year, and they are such a good company. AMD though, do they even make money? Let me see. No, AMD is losing a fortune. minus 400, minus 660. So there's $1.5 billion out the door in 3 years. Cash flow, cash flow, they're selling stock, so that doesn't count. But the cash flow is not terrible because they're selling their stock off while they're doing it. So they're diluting you while they're doing that. They're not making any money, and somebody wants you to pay. They don't even say what they want you to pay. Isn't that weird? How much? We'll figure it out ourselves. $12.50 times $800 million is looks like $1 billion, so it's about $12 billion. So someone wants to pay $12 billion for $4 billion in sales and $500,000 loss. And not for me. I'm sorry, $500 million loss. So to me, if I'm going to lose $500 million a year, do I really want to pay $12 billion to be able to do that? No. Really, to put it simply, no, that's crazy. I definitely have better things to do with $12 billion than lose $500 million a year. So that is my answer on that. A sell-off, yay! That's what we wanted. We bet on that. Woo-hoo! Look at that money coming in. 310, 4, wait, no. Yeah, 415. Oh, that's for the day. Wait, am I going to get my 1,000? Damn it! I want my 1,000. I'm not going to give up on it. So now my stop. So now we're below the 2,200 line. I'm going to stop at 2,200, of course, right? That makes sense. If it gets back over 2,200, I want to stop out. Here, I'd like to get below 82.50, and then I want to use that for a stop. So here's 82.50, and we'll see if that holds. It might bounce off that though. Let's see. I'm watching the 22 line here because they'll both probably pop up at the same time if they are going to. So like I said, there's nothing in the futures that was exciting enough to keep the market going. I mean, you have to anticipate that there's already an anticipation that the Fed would do something magical like they usually do. But what was in those minutes that would have made the market go higher? Nothing. What do we think? Should we stick with this? I say no. I think this is good. Let's see. Let me sell one. Whoops. Not selling it. Buy. All right. So now I've just got one contract on each, but I don't want to lose any money. Right? I'm trying to teach you guys how to win, not how to lose. So close, though. So close to 1,000. 400 plus 300 is 700 plus 200. I need $100 more. Damn it. All right, let's lock that in. You see what's happening? I'm greedy. All right, out and out. Okay, now we're flat. Okay, so 285 plus 212 is 300, 500, 870. So we need $130 more. All right, so that's my goal now. Is I want to figure out how to make $130 more so that we can make an even 1,000 for the webinar, and that way you guys have not wasted your time listening to me. All right, we'll look at that in a minute. But by the way, that's how you play the futures, okay? It's like I got a nice little dip. I'm not looking for a huge win. I just want to make 250 here, 300 here, 100 there. That's it. It adds up. While we've been sitting here in an hour and whatever the heck it is, in an hour and a half, I need 800 and whatever dollars. I mean, that's not hard. It wasn't hard work. I wasn't even paying attention half the time. It's just a matter of, the hard part is, as I was saying this morning, the hard part is doing my homework, reading and thinking of the market situation and where everything stands and what's going on and what the general pressure of the market is. And then once I have a fix on the general pressure of the market, then I can move to the TA part on the thing and say, okay, well, given I think the market is going to push down, then when I hit this resistance line here, which is exactly what we just did, when we hit this resistance line here, I want to take a short position because I don't think that resistance line is going to hold. Down here, I say, well, that was good. We went below 2,200, so I'm going to make that my stop, 22,000. And if that's my stop there, then of course I'm going to take the money, even though he doesn't hit the same stop. If he's going up, why wouldn't he probably go up? But I'm not going to play long because I don't have an inclination to play long. I think the market should finish lower. And if he keeps having trouble with 22,000, I might go back in again on this bet. But I was thinking they were going to bounce at this point. So now we're going to look to see what kind of bounce we get off this drop from 2230. So it's a 130-point drop. That means we'd be looking for a 25-point bounce, basically. So we're looking for a bounce to 22,025. If we fail, Wait a minute. No, I'm wrong about that. Sorry, 30. No, it's a 30-point drop. I'm doing the math backwards. It's a 30-point drop. So you're looking for a 6-point bounce. So 2206 right here is a weak bounce. Now, if they can't get a weak bounce, that means we're probably going to leg lower. And he's going to hit resistance here, so he's no longer a good bet. My good bet is still the Russell because he's got a long way to go before he hits any support. And then here's the S&P is also probably a good one. So I'm going to go back in on the Russell because I don't see it really improving here. 1, 2. And we'll see if we can squeeze out a little bit more money out of the Russell. So as long as he's under 22,000, I feel good about the Russell being short. But now what I'm worried about is if he bounces here, then the Russell might bounce too. So we're going to watch that and see what happens. But the Russell, and when the Russell hits 1380, it's probably going to bounce. So I'm only in this for a very short ride at the moment, if I hit it at all. He is not playing well so far. I'm not watching the Russell, I'm watching the Dow. Because if he can't get over 22,000, he's going to start going down. The Russell's going to go down with it. And let's look at the broader picture and see what else is happening. Oil, wow, oil took a nice spill. The dollar, and this is all happening. See, here's another reason. This is all happening with the dollar diving down. So the Fed, the minutes are being read as if the Fed is going to maintain a loose policy, which we already knew. But there's no new information. So if the dollar's diving and oil's diving, that means these oil traders are taking advantage of the dollar and selling their oil contracts. That's really bad because the dollar's not even supporting these indexes. They would be much worse off if the dollar hadn't fallen. This is a significant drop. This is 94 to 93.35. That is more than half a point on the dollar, and that half a point supports these indexes. But they're not being supported. They're failing anyway. So this is not good. This is a very bad situation right now for the market. It could go much lower. If the dollar bounces back, or if it just stays where it is and stops supporting them, these guys are going to fall harder than they've fallen so far. All right, so meanwhile on the active thing, our only trade open now. How much we got? 90? See, I really want to get out of this 80 mark here. Oh, see, here's the Dow testing that pink line where we thought it was going to bounce. And it is bouncing. And there goes my profit. There goes my $90. Come on, baby, you can do it. So we want the Dow to fail that line. I don't think it's going to happen, though, not right now. Just the dollar is too weak. And the dollar is only stopping us support, but the dollar is so weak that it's adding a huge amount of support to these indexes. But if the dollar gets bouncy here, we could have a chance. So there's no buyers. Notice 25 sellers, 91 buyers. Here you go. There's a block. 22 buyers, 4 sellers, 23 and 92. Here come the buyers, 89 and 1. Overwhelmed. 7 and 20. 12 and 11. Somebody's buying. All right, so that's getting bought. So that's good. Now, so what I can say, the dollar moving up means the indexes might get pressured lower. So this is a good sign. This is not a reason for me to get out of these shorts. But I'm still watching it. The Dow getting over 20 is still a reason, though. And we'll see what happens. We'll get back to this show in a little while. Chiba salvage swing. Yeah. How low can it go is the question. Teva's going to be a long-term turnaround, but so is Gilead, frankly. This happened to Gilead, and we bought it. So this happened to Teva, and we're buying it. It's the same story, basically. Gilead kept going down after we bought it. Teva kept going down after we bought it. Gilead has recovered. Teva has not. I think there's value here. I think the value is really up around $30, where we started buying in the first place. You just gotta have to wait for it to come back, and it could take a while. We're talking about 100% move up from here. I do like them, and but not so much that we're willing to accumulate them until we see a real sign of recovery. Let's see how Gilead look at the time. GILD. See what Gilead did. Gilead fell from 100 to 85, not as severe, but it just was relentlessly down and down and down and down and down, and we started buying it around here. And it's not that we were wrong, because we decided this was a good floor to buy at, and it went below where we thought it was a good floor, but the reality is it came back to that value. That's what matters. We said this is where we're willing to take an entry here, because we're not taking an entry for, I don't give a crap about what happens in 2016, 17, whatever year it is. I don't care about 2017. I care about 2030, 2040. These are long-term positions. I care about getting back to 100 and selling those, like in the example today in the article, selling calls and puts along the way and collecting my premium and making a long-term cash machine out of the stock. If you're just buying these things to buy a stock, this is not a good idea. The whole point is that we're selling these puts and calls all along the way. The only reason we're buying the stocks is to maintain a position so that we can then attach and we don't get burned when we sell puts and calls. But most of what we do is going to be selling this premium every month. All right. I'm on the computer. I thought I'd change my screensaver to not go off so often, because it keeps going off. Very annoying. Oh, how do you do? Yep. All right, so we'll climb down. Oh, 21,999. Oh, 22,000. Time to get off. Hang on. No. Nope, he's back over, so I can't play it. Oh, look how fast he's recovering. Oh, now I'm annoyed. Lost money. Oh, well. That took a chunk out of my profit. Nope, got to obey the rules. Okay, so he went over the 22,000 mark. That negated my premise, and therefore, if I don't have a premise, I don't have any other premise. Got to get out of the trade. You'd be stupid to blow the money. What happened to my other money? The Dow, the TF, was it EF? Yeah. So now I'm down to like 740, 750. 750. All right. Well, unfortunately, I really want to get to 1,000. Sorry about that. What about earnings plan on L brands? Target came through for us. Where was Target? We have Target in a few places. I think in the butterfly portfolio we cheated and went aggressive on Target, didn't we? Target. Yeah, in the butterfly portfolio we're bullish on Target. We have the $50 calls open and the short 65 puts. We had no coverage because I said last time this is just stupidly cheap for Target, and here we are now. So we'll see what happens. It's only a day, so you have to wait and see. But I'm encouraged because what I saw in Target was that this would be a good time to get longer. So when we did our options, our butterfly portfolio review, was that June something, right? I don't know. Whenever it was, or July, maybe it was July. So we decided to go bullish on it, and it's been moved up, and now it's come back down, now it's back up again. So we are right, though. This is where it's going. So it should be about 60. LB, the problem with LB is that they cut swimwear and something else. They cut two lines of clothing. So, of course, their comps are down. They don't sell two major things they used to sell. The reaction to this is one of the stupidest things I ever saw, because it's not that their comps are bad. It's just that they don't sell swimwear anymore. So if they don't sell swimwear anymore, it's a whole category of stuff people used to buy that is no longer available. Now, is it a bad thing they don't sell swimwear? No, because they weren't making any money on it. It was too many SKUs. It was difficult to stock. It was difficult to make money on. It had bad margins. They had a lot of returns because they get too much wear and tear, and it's not their thing. They decided to get out of it. And we took a hit, and we did a write-off, and blah, blah, blah. And now what happens is every time they get a quarterly report, the comps look terrible because they don't sell the frickin' stuff anymore. So, of course, sales are down. It is not a good reason to tank to tank the stock. So I like them. I think $40 is a good price to pay for these guys. And if you want to do an LB spread, I still think the market's going to go lower. I really do. But do I want to get back in this thing again? Not really. I'm not happy about where the rest is moving. If we get to 1385, I'd short it again. Anyway, where was I? LB, right. So, playing for pop and earnings, I would just go with something simple, like right here. Look at this one. They're at $39.73. You can buy the $40 calls in September. Now, figure they move up 5%. 5% on this thing is $2. All right, so that's a $2 move would be great for this. So if they pop 5%, this spread is 160 or 170. Let's say about 170 maybe. The last is 175, but they seem to pull back a bit. So if you look at this 170 and you sell these guys for 85, that's a net 85. Okay, so it's 85 cents on a $2.50 spread. And you're at the money, so you are paying 85 cents in premium, but if they pop $2, you're going to make 100% on that trade. Boom, boom. So that's a nice earnings play, right? I mean, you could do it in August, but that's an all or nothing play. There's no way to save it if you do it. If you went in August and you took the 40s, it's actually not much different. If you did the 40s here, they'd be about $1, and then these guys can sell for 40 cents to 60 cents. I'd rather pay 85 cents and have more time, because 60 cents here, and if they blow earnings, you're obliterated. Your money's gone. So to do that, to save 20 cents or 25 cents just to not have a month where you might recover, that's not worth it. So the way I'd play is a September 40, 42.50 spread for 85 cents. That's probably the best way to play earnings that I like. Now, also, of course, I like just selling puts. At this price, $40, you can sell, this is some crazy pricing, you can sell the $35 puts, 2019, for, let's say, $5.50, split the baby here. So $5.50, you net in for $29.50. That's just crazy. That's $10. That's 25% below the current price. And so basically they're paying you $5.50 to agree to buy the stock for 25% below the current price. Yeah, okay. That's the way I would play that trade. What did I end up doing? I forgot. I didn't get anything. See? Knew it. Fake. All right. We're going to do the Dow. Really? Oh, come on. What's this? 2. All right, 2's good. Start with 2 to see how it goes. So now we have 2 more short, 2201. And on the Dow, well, again, we're going to have trouble getting past this line. So let's say that is 980. Going 20 points down, it's a 20-point move times 10 per point. So $200 if I make it. We'll see what happens here. Now, we're not below the 22,000 line, so I'm a little bit worried, but I really just don't see why would they be higher. It just doesn't seem right, and especially considering how far down the Dow's come today. This is really not even a weak bounce from where it was. So to me, this is going to fail. But we'll see. All right. Nope. So do you like why I'm short? Yes, I do like why I'm short. That's what I just did. Oil, how low can it go? Oil can go back to 42 very easily. Again, there's a lot of contract pressure now, but that pressure is not going to let up. It's going to be the same pressure next month, or the same pressure the month after that. And people who hold oil have got to be really, really brave. We're only stopping here because you hit the bottom support. It's not, nothing usually goes below its bottom support. Sometimes, sure, happens. But the bottom support levels don't get broken that often. So if you see something down here, you say it's probably going to be it for the day. And you see RB is actually bouncing off there. It's also natural gas. Gas bouncing off it also. So it's pretty reliable. And so right now, that's probably going to be it for today. But tomorrow's another day. I bet these bars are all going to be much lower and adjusted tomorrow to allow for more downside. We'll see what happens. All right, not much time left. We're going to wrap it up, especially if my voice is caving in on me. All right, so I'm leaving my Dows on. I want to see how we close out. Hopefully the Dow will close out red, and I'll make my extra $200 and be over 1,000. That's my plan. Portfolio-wise, Butterfly, the options opportunity portfolio, how's it doing? 207, good. All right, 207 is good. So we're up over 200%, and this is our second year. We were from 8/8/215, so we are actually right in the week of our second year anniversary. I'll be doing a write-up on the options opportunity portfolio. Now here, this one's been more steady. We're better balanced here than we were in the LTP, STP. Like I said, in the STP, I felt that we were a little bit not as hedged as I wanted to be. Here, we're pretty perfect. We're not really, we're kind of locked in place. So what I'm going to work on when we make the adjustments in the long term, in the options opportunity portfolio and in the long-term portfolio, I want to work on more call and put selling. Because if the market's going to sort of drift along at this level, and it won't, and it doesn't, if it goes down, we're fine, we're covered. If it goes up, we're fine, because we have plenty of long positions. The problem is if it's flat, where is my money? And that money is going to come from selling puts and calls. So I want to sell more puts and calls, get a little bit more premium, so on and so forth. Not too many, because we're worried about a violent market move, but I want to sell some puts and calls to generate an income. Because it doesn't have to be much. If you make $5,000 a month in extra income, that's $60,000 a year. That's a lot of money. This portfolio has only gained $200,000 in 2 years. So if I sell $60,000 worth of puts and calls, that's $120,000. That's most of the money I made. That's why it's such an important strategy. It doesn't seem like much, selling a few thousand a month, but it adds up very, very quickly to quite a lot of money. So that's the Butterfly, and this was the OOP, and we looked at the short term and then the long term. How's it doing? 190. Oh, so close to 200. Yeah, 1.5. So we're up, we were 70 yesterday. We gained 20,000 today. Not a big deal. It's normal fluctuations. Just under $1.5 million on this one. This one has been going since November of 2013. So we're coming up on our fourth year. And these are a lot of long positions. They're in good shape. There's not too many things. We already cut ones we didn't like. But we do have a couple of dogs. We have Tiva. And Target's recovered nicely. So we got that. That's back in good shape. SBU's not so bad. IMAX has been killing us lately, but I love IMAX down here, though. It's funny, there was this rumor that these people have a movie pass or something like that. We're going to start, letting people see any movie they want for $10, which is bad for AMC, bad for IMAX, and all that. But it turns out it's not really true. So, and AMC isn't going to allow it. They're already fighting. It's a whole thing. And so we'll see what happens. Well, when something's too good to be true, it turns out it's too good to be true. Oh, Frontier is another one of our big losers, but we love these guys. We already doubled down on them. 2,000 shares at 26 is $50,000 worth of Frontier. So the question on Frontier is, what are we going to do? We can sell. See, now, if we buy more stock at 15, that would make it, let's say it's 14. That would make it 40-20. We can drop the basis to 20. That's thing number one that we could do, is drop the basis to 20. Thing number two, though, is if we sell the $15 puts of 2019 for, I think it was $6. Hang on. I mean, it's a crazy number. STR. So if we sell, it is $6. Wow. All right. If we sell the 15 puts, let's say we sell the 13 puts to be more conservative. We sell these for $5. That means we're netting into $8 on the new position. All right. So in other words, what I'm saying is, instead of spending $30,000, spending $28,000 back, that's how much we spend to get in. So instead of spending $28,000 to drop the basis to 20, if we collect $10,000 on the short put, the only way we get assigned is if it goes below 15, which is possible, but our net on the new entry, though, because we're selling it for 5, is 8. And so if we're netting into 8, it's 8 plus 26 is 34 is 17. So in other words, instead of biting the bullet now, instead of doubling down and averaging in at 20, if we don't double down and we just sell the puts, we'll average in at 17 even if things get worse. So I guess I'm kind of talking myself into that. Probably we're going to sell those puts. But again, no hurry, because we don't know where the bottom really is. It looks like a bottom now. Maybe we're wrong. Maybe it's actually worse than it looks. If you like why I'm short, break is small. Let me do that. Oh, okay, we did that. All right, cool. I think I'm done. I'm certainly, my throat's closing up, so I'm going to give a call of the day there, get some tea. I think I'll be okay for the rest of my voice, but I'll be, at the moment, strained. Anyway, all right, so that's where we are. I'm going to keep these Dow shorts just because I think we're going to have a sell-off. Oh, shit. I thought we were going to have a sell-off, but apparently somebody's happy about something. We're going to have to read the news and find out what's going on, but I don't know if I want to ride that out. Let's see. No, why should I? I'm going to just lose profit. It doesn't make any sense. So forth, it's a $90 loss at the moment. Let's see. I think I want to let it ride up to here, though. That's a lot. I'm looking for signs on the other guys. The NASDAQ's here. And he's here. So we'll see what the NASDAQ does on this line, 59.20. Okay, there. So if the NASDAQ goes over 59.20, I should pull the plug. If the Russell goes over 13.85, I should pull the plug. If the Dow goes over 22.20, I should pull the plug. These are the situations in which I should pull the plug. And at the moment, it does look like that's going to happen. So I'm going to pull the plug. Let's see. No, maybe not. Rejected and rejected. Very tricky. All right, anyway, well, that's what I'm going to be watching. So I don't want to take a big loss, but I'll see what happens. Because, I mean, we did make plenty of money. Now we're down to like $600 and something that I've made. That's how big, it comes and it goes very quickly. It's like you got to watch it. And I wasn't watching it, and that's what happened. But anyway, so we'll see into the close. If we can stay below 13.85, if we can stay below 59.20, 5 should be 25 there. And if we stay below 24.70, then I don't mind sticking with this trade. All right, and the Dow is the one that is down the least, so it should hopefully go down the most if it turns back down. That's where we're going to leave it, and I'll let you know next week how we do. All right, thanks everybody for coming. I appreciate it, and we'll do it again next week. All right, take care.